All right. Good afternoon, and thank you for joining us. My name is Jonathan Much, and I'm the Chief Operating Officer and a Financial Advisor at CTS Financial Group. We're grateful to be partnering with TKE for today's discussion on one of the most important and often overlooked aspects of financial planning, estate planning. One of the privileges of my job is walking alongside families through every stage of life. Unfortunately, that also means I've seen what happens when a loved one passes away without a plan. I watch families struggle through conflict during an already emotional time, and I've seen how the absence of a thoughtful plan can create unnecessary stress and uncertainty. I've also seen the opposite. I've seen how a well-crafted estate plan can provide clarity, stability, and peace of mind when families need it most. While no plan can take away the grief of losing someone you love, it can remove uncertainty, reduce conflict, and allow families to focus on supporting one another instead of navigating avoidable challenges. What I've learned is that estate planning isn't really about documents. It isn't even primarily about preserving wealth. It's about protecting the people that you love. At CTS Financial Group, we believe great planning happens when your financial advisor and your attorneys are working together and not in separate silos. Estate planning isn't something you do once and forget about. It's an ongoing process that should evolve as your life, your family, and your goals change. Before I introduce our speakers, I also want to say how excited we are to be partnering with TKE. I've had the pleasure of working with Jennifer and the TKE team for more decades than I'd like to admit, mostly because saying that out loud makes me feel old. In all seriousness, we've trusted Jennifer and her team with many of our clients over the years because we know they'll provide thoughtful guidance and genuinely care about the families they serve. Before we begin, just one quick housekeeping item. Please hold your questions until the end. Feel free to enter them into the chat, and we'll reserve plenty of time for questions and answers. With that, it's my pleasure to introduce our speakers. Jennifer Esposito is a founding member of TKE, and joining her is Brandon Akers. Together, they'll walk us through the key estate planning strategies every family should understand and some common pitfalls to avoid. My hope is that everyone leaves today with at least one action, whether that's creating an estate plan from the beginning or revising one that hasn't been looked at in a couple of years. Jennifer, Brandon, thank you both for being here. The floor is yours.
All right. Really so pleased and grateful to have this opportunity, of course, to collaborate with CTS, who I too am a little reluctant to say how many decades we have worked together, but also the number of clients that we share mutually. And so we're all looking out for you and your families moving forward. So it really is a great honor. So there is a lot of material to get through. I'm going to introduce my associate, Brandon Akers. And Brandon, if you would, I'll come back and assist with questions at the end.
Perfect.
Enjoy the show.
That'll be great. So, John, I think we're ready to go to that next slide and get started. Okay, so let's start with what a well-structured estate plan should accomplish. What should a good estate plan do? You know, it'll really serve its purpose at 2 points: during your lifetime and after someone has passed away. So during your lifetime, you know, right now you're in control of your finances and you're in control of your own healthcare. But one day you might get too sick to handle that. And that's where a good estate plan comes in, is that it should have a bundle of documents that make sure there's an efficient and smooth transition of the management of your finances and your healthcare. So that way it all keeps working for your benefit. Then, whenever someone leaves the room, as we say here, or passes on, a good estate plan will be set up so that way there's a private, timely, and tax-efficient transition of your assets to your loved ones. And John, I think we're good for the next slide. Okay. And so now on your screen there, you see a bundle of documents. So during life, there's 3 main documents here: power of attorney for healthcare, power of attorney for property, and a revocable living trust. So what do each of these documents do? So a power of attorney for a healthcare document is a legal document which allows you to appoint a healthcare agent who manages your healthcare for your benefit when you're no longer able to, all based on your instructions and preferences. Now, a power of attorney for property document allows you to appoint a property agent, which is somebody who handles your day-to-day finances, your day-to-day expenses for you when you're too sick to handle that yourself. Now, the revocable living trust is a legal document, and a trust can actually own assets. So what do we mean by that? That means when you look at your account, instead of it saying your name on it, it's got your trust's name on it. You can also deed property from yourself to your trust. So during your lifetime, your trust might own a number of assets. And while you're healthy and hearty, you can, as your own trustee, manage those assets that are in the trust. But when you get too sick to be able to manage those trust assets yourself, that's when your successor trustee can step up for you and continue managing those assets for your benefit. Now, for the after-death documents, you see there's the will and there's a revocable living trust again. So let's talk about the differences between the will and the trust, because they work together. So when you have a trust plan, your will does way less than you see it does on TV and way less than you normally think it would. Typically, when you have a trust plan, your will is what we call a pour-over will. Your will simply takes those assets that did not make its way into your trust in your lifetime, scoops it up, and pours it into your trust. Your trust is what's actually what we call the dispositive document. Your trust will talk about who your beneficiaries are, what they receive, and if there's any rules or protections regarding their inheritance. So the trust is really going to be the document that's important for making sure that your intentions are followed through and that your loved ones are taken care of the way that you want them to. And John, I think we're good for the next slide. All right. So what are some advantages a little bit more about talking about a revocable living trust? So it serves a number of purposes during your lifetime and then also after you leave the room. So first there you see avoids guardianship court proceedings. So when somebody becomes incapacitated, there might need to be a court guardianship process to where somebody is appointed to handle the assets that are in their name. Now remember, a trust can own assets, which means that some assets might be in the name of the trust. So in that scenario, if somebody becomes incapacitated and a lot of their assets are in their trust, the successor trustee can step up and manage those trust assets, and that will be handled separately and efficiently as opposed to a longer court guardianship process. You also see there the ability that a trust to set lifetime beneficiaries. So you get to decide all those assets that you put in your trust that we'll talk about in a minute. Are those just for your benefit, you and your spouse, you and your kids, or maybe you want to take care of an elderly parent? Using those funds, you can decide in a trust how those assets will be used. And then there you see continuation of gift and donation schedules. So if you're already currently giving to utilize your annual gift exclusion, which we'll talk about in a minute, and also making sure that you maximize your charitable deductions, and you're already on that path, using your trust assets, if you become incapacitated, again, your successor trustee can step up and just pick up right where you left off with making those giftings and making those donations. Now, after death, you see that there's a number of benefits to having a revocable living trust in play and well-funded. So after death, you see avoiding probate court proceedings. What is probate? So when somebody passes away, in Illinois, for example, with $150,000 or more in their name, meaning not in their trust, not payable in debt to somebody else, but in their name alone, or any real estate in their name alone, all those assets have to go through a court process called probate before they make the assets actually transition from the name of the decedent to the name of the decedent's beneficiaries. And that can be an expensive process. That can be a long process. For example, in Illinois, the first large period of time called the creditor claim period takes at least 6 months to get through. So if the assets were put into the trust during your lifetime, those assets that are in the trust are not subject to probate. So they can way more efficiently move from the name of your trust to your beneficiaries if they're funded into the trust. You also see there simplifying inheritance transfers. What do we mean by that? So remember, your trust is what's called the dispositive document. So it can lay out all the rules of who's supposed to receive inheritances from you and also talk about the what if. So what if a parent puts all their assets in the trust and they survive their child? What happens? Does it go to the grandkids? Is it split among the grantor's other children? You get to decide that in your trust. A estate planning practice that some people use is they just list their kids as the beneficiaries on multiple accounts at multiple financial institutions. The issue with that is each institution has their own policy of what happens in that scenario where the account owner survives whatever beneficiary was listed there. So you can simplify all that and make sure it's all working as intended if you use your trust to work through how the assets will transition from your trust to your loved ones. And then there you see protections for inheritance. So whenever somebody inherits from a trust, they can inherit two main ways. One way is outright, meaning they get the cash or they get the asset straight in their name, or they can inherit in trust. So think about a new trust share being set up for your loved one. And there might be some rules there about, it's always for that beneficiary's needs, but what rules are there to where the beneficiary can cash some of it out or they just get the income? You get to decide all those rules. But if the asset is put in trust and for the beneficiary after a passing and the trust rules are in play, the benefit there is, let's say that beneficiary is going through a divorce or a bankruptcy proceeding. The assets that remained in trust for that beneficiary's needs can remain protected. Whereas if somebody inherited without a trust and just received the asset in their own name, it would not be protected in those scenarios. And John, I think we're good to move on to the next slide. All right, so even when all the legal documents look right and all of it's all signed up, where do even those estate plans fail? And John, we're good to move on to the next one. Okay. So there's three main ways that we see estate plans fail even when all the legal documents are set up right. So first is failure to fund the trust completely, failure to understand your estate plan, and failure to update the estate plan whenever major life events occur. So John, you're good to move on to the next slide. So we'll focus on what we mean by funding a trust and failure to fund a trust completely. So what we're talking about with trust funding is what we referenced before, where we're saying, take the asset that might be titled in your name and retitle it into the name of your trust. So that might mean updating the ownership on some of your accounts, or that might be redeeding property around to be in the name of your trust. And here on the screen, you see a couple good points to check. And if you want to, you can meet with us or you can meet with your CTS advisor to help in this area. We help with this all the time to make sure that all the accounts are set up right and owned properly. But a couple points to check would be for the non-retirement assets, are those actually owned by your trust? And then for any real estate, is that actually owned by your trust? And then for retirement assets, if you have a spouse, that should be the primary beneficiary. But then for the contingent beneficiary on those retirement accounts, does that also list your trust? And then speaking of spouses, it's also good to look at the net worth between spouses and see if it's relatively even, or is it lopsided to where one spouse has a bulk of the net worth for the couple and the other one does not. So those are some points that we would be checking against the legal documents to make sure that the plan is solid from a funding perspective. Sean, you're good for the next slide? All right, failure to understand your plan. Now, trusts are very customized to each individual client's wishes, and there's a lot of options that we're happy to go over and discuss. But there's a couple points where you have a lot of choices that it's really good to look at your plan and make sure you can answer these questions you see on the screen. So the first one there, when do fiduciaries begin to act? So that power of attorney for property agent that handles your finances, that successor trustee that handles your finances, that agent that manages your healthcare. When do they get to step in for you? Do you decide? Is it a decision with you and your family members? Is a doctor involved? Those are all different ways that you can have somebody step in and decide who's going to say, okay, your time of managing has passed, and when does somebody jump in to help you out? Then also there you see how much discretion do these fiduciaries have? Whenever your power of attorney for property agent or your successor trustee is stepping in to handle your investments, do they need to be conservative with the investments or can they take risks? With gifting powers, is your successor trustee able to gift to themselves or not? You get to decide. And with healthcare, are there clear instructions for how you should be taken care of, the type of care that you want, and when do those end of life decisions come into play? You get to decide all those things in your documents. Then there you see is everyone being provided for sufficiently. A lot of times with blended families, this is a consideration when each spouse is coming to the marriage with children from a prior marriage, making sure that the surviving spouse is provided for as you would like, and making sure your children are provided for as you would like. And then there you see as well, does a beneficiary inherit subject to restrictions or protections? So we talked about this a little bit earlier, but a trust can be set up in a way to where there's some flexibility, to where your beneficiaries inherit through your trust and still have access to it for the most part, but has the protections in case there's bankruptcy or divorce. Or maybe one of your beneficiaries utilizes government benefits and needs what's called special needs trust provisions in place to where your beneficiary can get both the government benefits and receive what they need from the inheritance as well. So understanding your plan and making sure it works for your family and your specific needs is important. And John, you're good for the next slide? All right, and then failure to update the estate plan when major life events occur. So like we said before, the estate plan is heavily customized for you at your stage of life when you come in the door. And sometimes your family dynamics change, sometimes your wealth level changes. So you see a couple examples here. Circling back to your fiduciaries again. So let's say that you have your agents in place to take care of you and your successor trustee in place to take care of you whenever you're too sick to take care of it yourself. But what happens when those people become too sick or those people are deceased? Looking at your plan, it should have a good list of backups that would step in that successor trustee's place. But understanding that you might want an update whenever your fiduciaries can no longer help you is important. Then beneficiaries becoming at risk of bankruptcy or divorce. We talked about this a little bit. Your trust can have protections set in place for those people that eventually inherit from you. So if you think that this is more likely to happen, it's good to check your plan and make sure that those provisions are put in place to protect your beneficiaries. Then grantor net worth increasing. We'll talk about it in a minute when we get to the advanced estate planning section. But there are some wealth levels that trigger what's called estate tax or death tax. And we can make sure that those are as tax efficient as possible if the trust is set up for your appropriate wealth level. So you might have started with a plan years and years ago at one wealth level, and now you've grown to where you need a more complicated plan. And then at any time, whenever there's a death of a spouse, yes, there'll be some administration work things to happen to get those assets of the deceased spouse to their intended beneficiaries. But also the surviving spouse would need to look at their own plan, see how it works, and make sure that's still what they want, given that they are the surviving spouse. And John, you're good for the next slide? All right, so how often should you revisit your estate plan? How often do you check this? And John, if you go to the next slide, I think we got a good answer there. So you can look at your estate plan two ways. So one at a high level summary and then again, taking a deep dive into it. So at a high level, if you have a flow chart that shows the high level summary of your plan, it's good to have that with you whenever you're meeting with your CTS advisor. So that way you can make sure that your portfolio is lining up right and your estate plan is all working together the way that you want. Then whenever family dynamics change or your finances change, that's when you really want to go in detail to understand your plan. We can talk about your plan and make sure it still lines up with your wealth level and with your current family structure. John, you're good for the next slide? All right. So let's talk about, well, what we talked about before was, the essentials of an estate plan. So now we're going to talk about advanced estate planning. And what is advanced estate planning? So advanced estate planning focuses on reducing your gross estate to minimize or eliminate federal or state estate or death tax, or to protect assets from creditors. So what does that mean? What is your gross estate? So your gross estate is basically your net worth. It's all the assets that might be in your name, in your revocable living trust name, or that you might have jointly with somebody else like your spouse. And then what is estate or death tax? So what that is it's not income tax. It is a completely separate tax where the government looks at when somebody passes away and takes a snapshot of their gross estate, of their net worth, and then actually applies a tax to the estate based off that deceased person's net worth, based off of their entire gross estate. All right, so we're good to go to the next slide. All right, so who is a good candidate for estate planning? Well, that depends on when estate tax is applied. So it can be applied both at the federal level and at the state level. So federally, and this is 2026 numbers, but each individual has an estate tax exemption, meaning that if they pass away under this number, there's no estate tax applied at 15 million, or for couples, 30 million. Now, much lower is the state estate tax, which some states have and some states do not. Illinois is one of those states that does have a state tax, and their numbers are much lower. It's $4 million per individual, and it's $8 million for a couple. Now, you might say that you're not a resident of Illinois. It's still important to know the state's estate tax rules and limits, because this estate tax for Illinois applies to both residents, but also non-residents that have real estate in Illinois. So this might still apply. We find that this applies for clients where they came in the door, didn't think this applied to them at all, and then realize, oh wait, they have real estate in this state. And we look it up and, oh, you actually could be subject to their estate tax rules and might need this advanced planning. So there is definitely an estate tax motivation for advanced planning. And then business owners might also have a motivation to look at advanced planning. It might be because the business is a part of their gross estate and they need the estate tax planning and the business planning run together. Or they might want to try to shield some of their personal assets in case they're from creditors or suit that started based off of the business activity. And John, you're good for the next slide? Okay, so what are some examples of advanced estate planning? What do they mean? So we'll go through these, but a lot of them, the main goal is it keeps going to reducing that gross estate to minimize or eliminate the estate taxes. So we talked about an revocable trust, where you can put your assets in, take it out of this trust. It's all for you. You have total control. An irrevocable trust is different. So an irrevocable trust can reduce your gross estate by taking your assets and putting it into the irrevocable trust. But the trade-off is that you lose access and you lose control to whatever assets you put in the irrevocable trust. So irrevocable trust planning looks at, okay, of your whole portfolio, what assets are you not touching and you're never gonna touch? And maybe those are what you would fund with an irrevocable trust. Now, gifting strategies can also reduce your gross estate by gifting assets to people that you intended to leave assets to at your passing anyway. We talked a little bit before about the annual gifting exemption, and we'll go into more detail later, but basically you're getting your gross estate down by transferring your assets to other people. There's also charitable planning, which can reduce your gross estate by donating assets. And even if, which is great for people that are charitably minded, and even for those that aren't charitably minded, it might be a good strategy to use charitable planning. A lot of times we see assets that have a heavy income tax burden. It might be better to have those assets go to a charity, because you can both, one, reduce your gross estate, and two, when your loved ones take on your inheritance, they're not taking on assets in their inheritance that come with a heavy income tax burden. Then there's also business succession planning, which this is more that business motivator, of course, and that involves transferring income generating businesses to your inevitable beneficiaries while maintaining control. And we'll talk a little bit more of the strategy where you can do that in a minute. And then IRA Roth conversions. So, there's different types of IRAs, but two big types is just a traditional IRA and then a Roth IRA. A traditional IRA the tax is paid whenever the IRA is liquidated, meaning whenever distributions are coming from the IRA account to you or to your checking account, so on and so forth. Whenever a Roth IRA is put in play, the tax is paid whenever the money goes into the Roth under the Roth IRA first. And so whenever there are distributions made from the Roth IRA down the road, there isn't a tax liquidation event. There isn't a tax consequence event. So one strategy is taking those traditional IRAs and strategically converting them into Roth IRAs over time, which can both make it so that way your beneficiaries are receiving, again, assets that have less income tax burden to them. And two, that strategy usually involves reducing the gross estate as well. And so we're good to move on to the next slide. All right, so circling back to the irrevocable trusts, we have a couple common types on the board, on the screen here to go through. So one is an irrevocable life insurance trust. So let's talk about how life insurance trusts work and life insurance generally works. So if you have a life insurance policy where it's in your name, you're the owner of the policy, and maybe it's for the benefit of your loved ones, that death benefit is still a part of your gross estate. For example, let's say you have $50,000 in your name and you have a life insurance policy that says upon your death, $4 million goes to your child. Well, when Illinois looks at your gross estate, they say your gross estate is $4,050,000. The life insurance, a death benefit of $4 million plus the checking account with $50,000 in it. So how could an irrevocable life insurance trust help in that scenario? Well, if the irrevocable life insurance trust is the owner of the policy and the beneficiary of the policy, which your children or whatever beneficiary you like could be the beneficiaries of that trust. But under that setup, the irrevocable life insurance trust and that death benefit from the life insurance policy do not count toward your gross estate. So same scenario, life insurance policy, death benefit of $4 million, now going to the irrevocable life insurance trust and the $50,000 checking account. Whenever Illinois would assess that client or that case, Illinois would determine that it's a $50,000 gross estate, just the checking. The insurance would not be involved. All right, and then you see there a grantor retained annuity trust called a GRAT. So the general purpose behind a GRAT is to transfer appreciating assets to your loved ones. So the way that a GRAT generally works at a high level is you'd establish this type of trust, and then you would fund a highly appreciating asset to the GRAT. All right. Then, in turn, the GRAT would issue to you annuitized payments over a trust term. It might be a term of years. At the end of the trust term, the total payments that will come back to you from the GRAT would equal the amount of the value of the asset you first put into the GRAT, plus maybe some interest that is set at a rate by the IRS. But also at the end of the trust term, the GRAT can issue that asset you first funded into the GRAT to your beneficiaries. So at the end result, your beneficiaries have walked away with that appreciating asset, and all the appreciation that was going on in that asset whenever after it moved from you into the GRAT, that appreciation, with that being transferred to your beneficiaries, that is not a part of your gross estate. So it is a good way to transfer a highly appreciating asset to your beneficiaries. And then there you see the spousal lifetime access trust. So it works very similarly to a GRAT, where you might take an appreciating asset and put it into the SLAT. But this time, instead of getting annuitized payments from the trust back to you, instead there would be an opportunity for your spouse to access the trust's income and principal for their needs. So under all those irrevocable trusts, again, that theme of you're giving up some control, you're giving up some asset, and in return, you are lowering your gross estate. All right, I think we're good for the next slide. All right, so some gifting strategies. So at first, there's annual gifting. So each year, there's a different annual gifting exemption amount. 2026, it's $19,000. So what does that mean? That means one individual can give up to $19,000 to another individual without having to file a gift tax return and have that gift be a part of their gross estate when they eventually pass away. Now, I said individual to individual. So this multiplies very quickly whenever you're looking at you're an individual, your spouse is an individual, both giving maybe to a child and maybe to that child's spouse. So for example, if a married couple it wants to maximize your annual gifting exemptions and give to 3 of their children and each of those children's spouses, you're looking at an annual gift of $228,000 a year. So it really multiplies very quickly because instead of going from 1 to 1, it's 2 people to 6 people. It just can multiply. Then you see direct payment of tuition. So what is still considered a gift is if a donor writes a check to their child and the child takes the check addressed to them and then pays off their tuition. That's still a gift. But if the donor writes a check to the school and then the child uses that specifically, that check address to the school to pay off their own tuition, that's not a gift. So that is if you attempt to do that, it's good to have legal counsel walk through that specifically to make sure you're checking all the boxes. And it's a very tight definition of tuition here, but it is an opportunity to use. Also, direct payment of medical expenses. It's very similar mechanics. So writing a check directly to the medical provider, which your child in turn turns over to the medical provider to pay their medical expenses. That would also not be considered a gift. But you want to check with counsel about the definition of medical expenses and what you're actually using it to pay for. So there are these gifting strategies available. I think we're good for the next slide. All right, charitable planning. So there's charitable distributions at death we're going to talk about, and then also something called a charitable remainder unitrust or CRUT. So first off, the easier one is charitable distributions at death. So donations to a charity through your revocable living trust that you specifically bequeath to the charity results in a dollar for dollar reduction in your gross estate. For example, if you have $5 million to your name and you decide that in your trust that you're going to give $4 million of it to charity, then when Illinois looks at your gross estate, they just see 1 million, not the 5, because your trust says to donate that 4 million to the charity. So that's what we mean by dollar for dollar reduction. Now, a charitable remainder unitrust is a little bit more complicated, but the highlights of how it works is that a grantor transfers an asset to the CRUT, to the trust, and the CRUT has that asset for a term of years. And during that term, the grantor's non-charitable beneficiaries are able to receive distributions from the CRUT. And then when that term period is over, then whatever remains in the CRUT goes to charities. That's the basics of it. There's specific choices that can be made about how much is distributed, but the rules are that at least 10% of what's originally donated to the CRUT has got to make its way to charity. So it's a good collaboration with our office and CTS's office to talk about your assets and whether a CRUT might be right for you, and to run through the math to make sure that the CRUT works well while hitting all the legal requirements. But there's a couple of benefits. So one, eventually you are making a distribution to a charity. So whenever the CRUT is first funded, there can be a calculation made and there can be a significant charitable deduction made on your income taxes the year it's funded. And then two, it can help lower the gross estate by that amount that does make its way to charity. And then third is we can increase the spread of some assets going to your children. So what do I mean by that? For example, if someone is going to inherit an IRA directly from their parent, the current laws say that that inheritance would be subject to what's called the 10-year rule. So the 10-year rule says that the child will need to liquidate that IRA over the course of 10 years. They can liquidate more aggressively if they want to, meaning they can cash it all out the year one that they get it. But what they are required to do is at least distribute out a 10th in year one, a 9th in year two, an 8th in year three, to where it's substantially equal distributions of the IRA over the course of 10 years. Now, taking that same asset, that IRA, and putting it into a CRUP model, we can increase the spread much longer than 10 years, to where maybe that beneficiary is receiving distributions from that IRA, maybe over the course of a couple decades, or their life expectancy, depending on their age. There's just a lot more options and flexibility. So for people that are charitably minded, the CRUP can be a great vehicle, but also even for those clients that are not charitably minded, CRUP can be helpful just to serve the purpose of increasing the spread that a beneficiary receives in income generating assets. That way they can smooth out that income tax liability they'll feel from certain assets in that grantor's original financial portfolio. And so, John, you're good for the next one? Then business succession planning. So we'll talk about family limited partnerships in this example. So under a family limited partnership, I think we're good to go back, John, just one. Great. So with a family limited partnership, there can be general partners and there can be limited partners. So the general partners still make all the decisions and have the control. The limited partners simply take distributions from the business. So this would be a good model if a family has an income generating business and their goal is to transfer the income that's being generated to their kids without gifting the money itself. Well, over time, the general partners, the parents, and they, for example, can start to transfer interest over time to their children as limited partners. So whenever the business generates income, the parents aren't taking 100% of the business income. Their kids start to take more and more of that business income, but the parents can still keep 100% of the control. All right, and then I think we're good to move on to the next slide, John. All right, so now we're on to IRA Roth conversions. So this is much more of a case-by-case analysis that needs to be done of the portfolio to make sure that one of these is right for you. But at a high level, remember we talked about how a traditional IRA, whenever distributions are made from a traditional IRA, that's when there's income tax liability. But with a Roth IRA, you're paying that income tax when the IRA is first funded. So when eventual distributions come from a Roth IRA, there is not an income tax liability event. So sometimes people look at their portfolio and realize, oh, we're very IRA heavy, and one day our kids are going to inherit a lot of traditional IRAs that will have a lot of income tax burden. So we talked about how a CRUP could be helpful in that scenario, but a family might want to look at saying, okay, let's convert some of our traditional IRA funds to Roth IRA funds over time, so that when our children eventually inherit from us, they're taking less assets that will come with a big income tax liability. All right, and so I think you're good to go on to the next slide, John. All right, and so, yeah, and so we've gotten through the meat of our presentation here. After this is nothing new. We're just going to go over maybe some examples and then maybe open it up for some questions. And I think Jen is going to slip right back in here.
Coming back in, Brandon, you really beautifully provided a tremendous amount of information for everyone to absorb. And sometimes with all of that, there will become questions down the road. And both our firm and certainly CTS welcome anyone on this production or that may later have questions to just give either of us a call to just consult on what your particular situation is, and so that we can advise you appropriately on what would best suit you, which is really what we're all after. another thing to highlight with Brandon, and likely you could see it in the explanation, is that if your lawyer is siloed off and preparing documents for an estate plan, and then you take those documents and you put them away and don't revisit them, and you don't even tell your financial advisor or your other institutions about the existence of them, you could see how you're going to run afoul of what you really wanted, which was an estate plan, at least the essential level to accomplish your goals. But the thing that it really does, as Jonathan had mentioned early on, and we see it very often, is when an estate plan is done and funded and understood, with perhaps a little explanation from time to time from the financial advisor or the attorney, then the result will be that when someone leaves the room, as we say, that your children or spouse or whomever is going to succeed you as trustee or beneficiary, you make it almost seamless. It's not 100% seamless, but almost seamless for them to step in and take over. And also avoid what we always try to do in probate. And so the more solid the plan, the more funded the plan. When you look at it every couple of years or every life event that happens, you'll be and consult with your financial advisor and your attorneys from time to time. You really build the means by which your children will have clarity and stability and ease when the time comes. So again, we know there's a lot of information here, and feel free to consult with CTS. Feel free to contact our offices, and we'll be happy to address them with you individually. Also, if you'd like, of course, please, if you wanted to pop some questions in now, but feel free to put into the chat session right now any questions you might have. No question is too small or to be answered. But in the meantime, you'll get a couple that I made up. You'll probably do a better job. So one question, Brandon, that comes up is a client will say, well, why can't I name my spouse and my child as the people to make decisions for me under my healthcare power of attorney? And that I want more than one person to make decisions.
Yes, great question. So this varies by state, but in Illinois, your fiduciaries for your power of attorney for healthcare and for your power of attorney for property have to be one at a time. And it's strong. So that means that one person is in charge at a time. So one person is the final say when talking to the doctor for healthcare. One person is responsible for handling your bills and your finances at a time as agents. Now, when it comes to your executor, after you've left the room, and your trustee, you can have co-executors and you can have co-trustees, but for healthcare specifically, it has to be one at a time. Great question.
So that if I name, if I have to figure out the name as a trustee or successor trustee of my trust after I'm gone, is it good to name my 5 kids? Because I don't want to pick among them.
So if you do pick co-trustees, the default is that all of them are signing off before any action happens. So you can kind of think about how many financial decisions you're making on a daily basis, especially with those in your trust. And it is just going to be inefficient and hard to have that many of your children agree. Or even if they do agree, get them all in the room at the same time to get all the documents signed off.
Okay. So it's better if I had fewer people and maybe one, but maybe two.
Yes, so having a small set or one trustee is a great way to keep things efficient. And that sole successor trustee with the right trust documents should have the option to delegate. So if they think it's too much for one person, they can delegate some of that responsibility as they see fit. So leave it up to your kid to decide when they need help.
Okay, another question is, can a state plan be completed without ever coming to a law office or financial planning office?
So you mean whether it has to be signed in person or
Mhm.
whether someone could do a plan on their own and try to figure it out? We could talk about both.
I think both are both good discussion points,
Yeah,
Brad.
both good ones. Okay, so a person might be able to try to figure out how to draft their own estate plan, and they might find some forms online, and they might have some documents, and they might sign them up. But these are very, some documents like the power of attorney for healthcare and property do stem directly from Illinois statute. But these trust documents can be very complicated. And it's very easy to sign a piece of paper that you misunderstand to where it does not align with your wishes and does not take advantage of all these, say that tax exemption planning that we're talking about, all this income tax planning. So it might be possible, but it could be very subject to mistake, costs, upset family members because of the mistake, and not match up with the intent. And then also when you're talking about signing, it's great to come into the office, and look at all the documents because a lot of these documents need to be witnessed and notarized. So having a signing physically in the office is great. Illinois does allow for some remote notarization and some witnessing that could happen with the use of Zoom, but those rules are very specific. So that can be done. It can be done as well.
Okay, any other questions from the crowd?
Let's see.
We have one here. The question is, if we set up an estate plan, and it says will, a lot of people just refer to will when it's really the entire plan. But if you set up a will years ago, and you no longer have property in Illinois, say you've moved away, is it recommended to work with an attorney in the state you moved to if you relocated and are a resident somewhere else? Or can I leave it as an Illinois trust?
So that's something
And
that
when?
yes, so that's something that we would really look at on a case-by-case basis. Sometimes a plan established in Illinois, when somebody moves to another state, is fine to continue having the trust, for example, under Illinois law, and there's no issue. Now, when they go to a different state and has a different set of rules, for example, maybe a community property state, sometimes it's advantageous to keep Illinois still. Other times it's advantageous to actually have it change to be pursuant to the laws of that new state. So it really depends on that person's asset portfolio, on their family structure, whether they're married or not, and to really make that call. So that would be case by case, whether it makes sense to continue with that under Illinois law or transfer it, and even then consulting an attorney in that new state.
Okay, great question. And that does come up quite a lot. And so, for example, we frequently receive phone calls or inquiries about those kinds of questions. And then when we dig down a little bit with the client, then we can guide them appropriately. And if it is an attorney in another state, then if we know someone that we trust, we're always happy to refer. Otherwise, we can, and to the extent that our office can assist, we'll do that as well
With the transfer.
with
Yeah.
the transfer.
Yeah.
Which is great. Okay, that was a great question. Any other questions? So the firm's contact information, I'll just give you our phone number, which is 224-529-0500, and you'll see it in some of the information that's already been circulated. Otherwise, we're going to shoot you back to John so that he can get towards wrapping it up and solidifying CTS's information for their use.
Great. Thank you so much, Jennifer and Brandon. This was a really insightful presentation. A lot of really difficult topics that are really important. And just a couple of the points that I want to emphasize is, as with all aspects of financial planning, but also with estate planning, it is a living, breathing situation. We don't have the luxury of just setting it once and being done with it. You can't just establish, some legal documentation once and be done. Investment strategies change over time, as Brandon was saying, with different life events and so on and so forth. And working together with a firm like TKE and CTS, we can verify your trust is funded correctly and that the titling on your accounts is according to your wishes. TKE can get involved to ensure that you understand the complexities of the estate plan and help you strategize when there's opportunities for improvement, right? Many people view it as a challenge. It is not inexpensive for professional advice, but it's really a situation where, whether it is from TKE or from us at CTS, you get what you pay for. And with a situation as important as this, ensuring, the well-being of your family, we certainly encourage you to reach out and contact us for a consultation in any way that we can help. And if there's anybody who, would like to get in touch with Jennifer and Brandon and their team, please feel free to reach out to us and vice versa. Everybody from TKE who, needs help with any financial advisory services, we are always available, and we really take a lot of pride in working together to help create, safety for our clients and the people that we truly care about. So, one last time, if there are any questions at the moment, please feel free to type them into the chat box. And if not, we will follow up as always, but we are always available to answer any questions. So, reach out to Brandon and Jenny, reach out to me, and, we will point you in the right direction. So, Jenny, Brandon, thank you so much for your time.
Thank you all for the opportunity.
Thank you.
Everybody, thank you for joining us on this lovely day. If you're in Chicago, it's very, very hot outside. So please be careful, and we really appreciate it. We will be in touch shortly. We will send follow-up emails with additional information and articles of interest. We hope you all have a lovely day. Thank you again for taking the time to join us.
Thank you.
Thank you. I know.
Great job, guys.
Think it was too much for people?
No, I think it was really good. I think,
Okay.
I think it was, really, really good. Great job. I mean, this
Yeah,
was,
you did
Oh,
great.
thank
Yeah.
you, thank you.
yeah, that was amazing. You know, we had about, looked like there was 20 people that were, that came in, so that's great. We will send out, you know, all the information, and obviously, as you guys know, you know, you're the first person, so, you know, I found a lot of the time, I mean, Jenny, you know this, but Brandon, just at the risk of sounding redundant, people like, it's helpful for my clients if they're looking for somebody new. I'll just ping you to, and I'll just be
Sure.
CC'd on there and just be like, I'm making the introduction, kick me off, take it from here. Sometimes it makes them feel better. You know.
Perfect. That's great. Thank
So,
you.
Thank you so
Good
much.
job.
We will do that. Thanks, guys. This was great. These are really good. And I mean, we can, you know, get into like the marketing metrics and the impressions that we see online. Like, you know, it's really good for driving organic growth. So,
Right.
you know, any topics, you know, I just view this as like a good introductory level, you know, topic. I mean, we could obviously go on and on and on
Okay.
with stuff like this, and it's really good
Right.
visibility for the firm.
Good.
So
Good.
awesome.
Love
Thank
it.
you. Thank you both.
Thank
Um,
you.
See you
All right.
soon.
Happy 4th and everything.
Yeah,
Yes.
you guys too. Have fun.
All right.
Thanks.
Thanks.
Bye-bye.
Bye.